Hi, okay, good morning. Welcome to Saxo's weekly market outlook call. I'm Charu, market strategist with Saxo Markets Singapore. Let's dive right in. So we are still in a risk on mode. Markets are continuing with the bear market rally because earnings have been less bad than expected. So companies are beating estimates that were too low to begin with. So why do we still call it a bear market rally rather than a bull market? Because macro conditions are still suggesting a pretty tough environment. The US inflation number this last week has, of course, spelled some relief for the markets, and rate cuts started to get priced in for next year. But we think that's premature. Our view is still that inflation will be higher for longer. And there are two key reasons for this. So, whatever relief we saw in the CPI number was due to energy. Even the core print was lower because of mainly the aviation prices. And that's also probably a function of lower energy prices over the last quarter. But what really stuck out was the shelter costs that are still rising. And these are more sticky. They are usually late to rise in a cycle and they usually last much longer. So this suggests that we will continue to see inflation remaining around that 8-9% range for a few more months to come. And I think it will be, of course, as energy prices rise again, that could possibly be a bigger threat to the headline numbers. Secondly, financial conditions are easing now. Equities are rising, yields falling, better corporate earnings, higher wage growth. So all this is making financial conditions easier as against the Fed's hope to really tighten. So that is again also reflationary. That is just making the Fed's job much tougher to do. So like I said, I think our sense is that it is still premature to start expecting the Fed to ease policy. Both of Fed's mandates, inflation as well as unemployment, are still suggesting more aggressive rate hikes. And we've seen that. I mean, after the CPI print, a lot of these Fed speakers came out and they've been pushing back against these easing expectations for next year, and still guiding for being aggressive and being kind of committed to inflation and not being bothered about somewhat of a slowdown in the economy. I think potentially there is still more room for the markets to reprice these Fed expectations and the terminal Fed rate. That's something we've been talking about, and there's potentially more room on that. So what does that mean in terms of the markets? Like I said, we think there's more scope for the US yields to go higher. The US dollar also probably has some more runway. It could go higher. We have the FOMC minutes from the July meeting due this week. So that is a potential market mover if there is more light into the committee's thinking on future rate hikes or the terminal rates, like I said. So that means equity markets will see a turn lower at some point. Right now, what we have is really a momentum rally and a relief that earnings have been less bad. But with when the market comes to realize that there are more Fed rate hikes to come, and let's not forget, I mean, there's also the quantitative tightening from the Fed, which is still not at its full pace. So that will still mean more liquidity being drained out from the markets. So overall, it's our sense is that things will turn at some point. But where do they turn? Again, that's an important question that we keep getting a lot from clients that we speak with. If you look at the technicals, we had the Nasdaq close above the resistance at 13,542 on Friday. That could mean some more upside for now. Our technical analyst points out that the next key levels to watch would be 14,265 and 14,577. The S&P 500, meanwhile, still needs to clear the 4,300 levels. So the trend there is a little bit more choppy. We could possibly see some, choppiness over this month, at least until we approach September FOMC meeting. We do have two more key data points for the Fed to consider at its September meeting, the August CPI as well as the jobs data. So I think once we get closer to that is when we will be likely seeing a more definitive downtrend. But until then, we could go sideways a little bit higher from here still. Anyway, let's switch gears to FX now. Over in the FX markets, the dollar was broadly weaker last week with the Fed rate cuts being priced in for the next year after the softer CPI print that we saw in the US. Some recovery was made into the end of the week with, like I said, the Fed officials kind of still pushing back against these rate cut expectations. The biggest gainers because of this dollar weakness primarily were the commodity currencies, the Kiwi and Aussie. They made the best gains, with, of course, obviously the commodity prices pushing higher too, so that helped. We have the RBNZ meeting this week, which is likely to hike rates by 50 basis points for a fourth consecutive time. And for the Aussie dollar, the key to watch will be the jobs data and the RBA minutes due this week. USD yen is turning lower again this morning. I saw from the 133.50 level. The next level to keep in mind there is 131.50. We did have a weaker than expected GDP print from Japan this morning, while inflation has, of course, been overshooting the 2% target. So the macro conditions are tough in Japan as well. We have a fresh rise in COVID cases. So that does mean that the GDP growth that we saw for the second quarter is likely to weaken further into the second half of the year. So, of course, I mean, it's unlikely to expect any Bank of Japan pivot now at this point. But what remains more important for the yen is the US yields. Certainly, the US 10-year yield going above 3% could mean a lot more pain for the yen still to come. And I think, again, key to watch this week would be the euro dollar as well, which is facing pressures now because of the situation on the Rhine River, which is hindering trade in the region. In the commodity side, we had some correction last week because of the weakness in the dollar, which, I think there is some potential this week that it could turn back, especially also we had China's loan growth reported on Friday that was weaker, much weaker than expected. Plus, we have a fresh rise in COVID cases in China, and there are new restrictions being announced in many cities. So that does mean that commodity demand will come in question again. Gold, I think, is important. It stays near the key 1800 level, and it is like awaiting its next trigger. So we still remain bullish on gold as a hedge and a portfolio diversifier, with also now geopolitical tensions becoming a key concern. So that should remain interesting if at all we do see a next trigger for that. And oil has been, of course, more focused on the supply issues again last week because demand concerns were eased somewhat. Plus, we had the IEA lifting its global consumption estimate, whereas OPEC, of course, is still struggling to raise output in the coming months due to the limited spare capacity. With that in mind, we still have our oil price target at 95 to 115 for the third quarter. So just something to keep in mind. That's it from me, and I'll hand it over to Redmond from here.
Hi, morning everyone. In the US equities market, and since actually last Wednesday, investors and cheered for, they took in bond yield after the CPI, rather weaker than expected CPI, and now the market is expecting actually the pricing 61 basis point for the September FOMC, i.e. is a 50 basis point pretty much for sure, but not so sure, and much less chance now for 75 basis point hike for September. And also the market has also been pricing in a more dovish path going forward. So so we have a Nasdaq 100 gain 2.7% last week, and S&P 500 up 3.3%. And on the corporate results, and basically the equity market were helped by the better than fear corporate earnings. In the S&P 500, 457 company have reported, and this company accounted for over 90% of the capitalization in the S&P 500. 52% of them had earnings actually beat the consensus estimate by more than at least one standard deviation, and historically it's around 47-48%. So it's better than basically it's more company beating earning estimates, so that help the stock market as well. And on the US, on the bond side, and it's very choppy last week, and we have a big steepening, huge steepening on Thursday, and then pretty much reverse most of it on Friday. And on Friday, after the U of Michigan data, and we have seen the Treasury yield curve flattened for 210 flattened for something like 8 basis point, more than 8 basis point, and back to minus 42 basis point. And so I mean, some of the Fed speak also reiterate not so sure whether it's 50 or 75 basis point for the September FOMC is very much data dependent. I think that another key thing to watch would be the Jackson Hole conference later this month, and see when those central bankers get together to discuss about obviously inflation and policies. And another thing I would like to bring to your attention is the VIX, the volatility index in the US stock market, and has been coming down as on a risk-on mode. And VIX went below 20 since this first time since April, and I think it closed at 19.5 yesterday. And another side of risk-on and is also on the credit spread. If you look at the high yield credit spread in the US, and last week has contract or narrowed by 10 basis points, and the ICE BOA US high yield OAS spread came down to 446, and the Bloomberg Barclays high yield the spread came down to 432 basis points, more or less 10 basis points. So it's both VIX and spread coming down. So again, it's a risk, giving us some impression that the market's in a risk on mode. And then back to this part of the world, in Hong Kong and China, and notably last Friday you have Li reported better than expected results, and the share price up almost 5%, and that gives some at least some relief to the situation in the Chinese consumer, and also related to consumer demand in China. And you have China EV sales volume grow 124% year on year at the wholesale level in July, and then in retail level is it was up 117%, and so that was also triggered some buying in the EV space. By the way, today Li Auto, the ADR, I mean, they are releasing results in the US today. However, on the semiconductor side, even though Hua Hong reported better than expected earnings, but SMIC, after they reported sort of inline result in the management conference call with analysts, the management of SMIC, the largest semiconductor manufacturer in China, said some of orders from some of the customers could fall meaningfully in the near term, and basically due to high inventories. And so they expect the situation will not improve until end of this year or early next year. And so that's just some shadow over over the semiconductor space in China. And so far in Hong Kong, Shanghai, and Shenzhen, and 16% of the total market cap companies already reported the first half results, and the earning growth is 4.4% year on year in the first half, and for the second quarter is 8% year on year growth. But that's only for, I mean, so far only 16%. I mean, company accounted for 16% of the total market cap reported, or so there's more to come. And then, as Trevor already mentioned, and the last week, the China's aggregate financing and loan data growth were a little bit disappointing, and that has decelerated. And one of the things mainly is the medium to long term loans to household that came down quite a bit, and that is of course that represent mortgage loan, and that that points to still a worsening Chinese property market. And new loans to corporate sector also plunged quite a lot to 288 billion from June's over 2 trillion. So it's so that is also corporate demand, loan demand was also quite weak in China. And another thing, last Friday, and five those central state-owned enterprises, including PetroChina, Sinopec, and Sinopec Shanghai Petrochem, Chalco, and China Life Insurance, and they announced that they have notified the New York Stock Exchange and they will apply for delisting their ADS from the New York Stock Exchange. Yeah, I mean that can create a little bit of selling over in New York on Friday, also on the Chinese internet stock, and because it's a market worried that whether they will be the next to do that. And it's also reported in the Wall Street Journal, and President Xi is expected to meet with President Biden, either during the G20 meeting in Bali, Indonesia, or the APEC Economic Cooperation Summit in November. So see whether they will sort out, resolve some of the issues, recently between the China and the US. And then the China, Hong Kong, the real GDP number has revised down, came in rather weak, and down 1.3% and year on year, and up 1% quarter on quarter, and seasonally adjusted on the annualized, that was lower than the preliminary number. And then for the full years also, the target also revised down. And so last but not the least is earnings, and Canada is rather light in the US, but more in the US ADR, I mean Chinese ADR, and Meituan and Li Auto, as I mentioned, will report, and today Hong Kong Meituan also will report, and also we have Tencent, and also Billibili and Xiaomi later this week. And and in the US, I think the key earnings result for this week will be from we need to watch it from Walmart and Home Depot, and that will give us some ideas about how the US consumers are doing. And I think that's all from me for today. And I think I overrun. We wish you all have a very good week trading, and we speak to you again next week.
And yeah, don't forget that we do write a daily market update and what to watch every morning. Let the RMs know if you want to be added to the Strats email distribution lists. And that's it. Yes. Talk to you again next week.
Yeah, thank you, everyone.
Bye.